Hello and welcome. This is Kathleen Novito, and I will be your host for today's webinar on 4 behaviors that can improve your financial health. Our presenter today is Young Park, Senior Relationship Manager with AAFMAA Wealth Management and Trust. Before we begin, here's some background on the company. This webinar series is brought to you by AAFMAA Wealth Management and Trust. Our mission is to be the premier provider of financial planning, investment management, and trust services for the American Armed Forces community. AAFMAA Wealth Management and Trust is a fully owned subsidiary of AAFMAA. AAFMAA has proudly served America's Armed Forces since 1879. AAFMAA is a nonprofit, tax-exempt 501c23 member-owned mutual aid association offering life insurance to all branches of the U.S. Armed Forces and their families. And then just a few disclaimers. This presentation is educational. It is for general information only and is not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your investment management decisions. Since each situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members to help them better understand the resources available to them. We have highlighted here 2 distinct characteristics that separate AAFMAA Wealth Management and Trust from other service providers. 1, our fiduciary standard, which requires us to always act in our client's best interest. And 2, we exclusively serve the U.S. Armed Forces community. So with all that out of the way, I'll turn it over to Young to begin the presentation.
Great. Thank you everyone for joining us. I'm Young Park, and today's webinar is about 4 common behaviors that can positively impact your financial health. At AAFMAA Wealth Management and Trust, we offer financial solutions to the military community and their families. In conversations with our members, we've seen how negative habits can result in poor retirement planning and poor long-term financial health. We've also seen the positive impact of 4 behaviors: paying yourself first, saving with a big picture or a comprehensive financial plan in mind, planning for the unexpected, and working with the right financial professional. We thought we'd share a little bit more about both common steps and positive behaviors so you can avoid mistakes and secure financial independence in your retirement. As you might expect, saving money, or more importantly, not saving money, often has the biggest impact on your retirement and overall financial health. As this survey image shows, more than 50% of Americans have less than $10,000 saved for retirement, and 1 out of 3 have no retirement savings at all. Many Americans don't save because of certain socioeconomic pressures and influences. But even if you know how important it is to save, there may be additional limitations or financial obligations, such as college loans, medical loans, and others, that can prevent you from getting started. The good news is that even though savings is often the biggest hurdle to financial freedom, it's also the easiest to mitigate. A possible solution by paying yourself first. In many of our conversations with members, we've heard them say, well, after I pay for this and that, after I pay for that, I like to put away whatever's left over into this savings account. Sadly, this strategy often doesn't work. Instead, it's best to pay yourself first. Shifting your mindset from I have to save for retirement to I'm going to pay myself first can go a long way in your sense of financial empowerment and planning. Employer-sponsored programs like 401k, 403b, and TSPs can automatically route a specified contribution directly from your paycheck before any money is deposited into your checking account. This way, you can establish a system that pays yourself before you pay the rent, mortgage, and everyone else. Many also find that by automatically routing the money to a separate account, they're not tempted to spend what was never deposited in their checking account to begin with. Not sure how much to save? Have other financial obligations such as school loans, credit card bills, and worry you can't pay yourself at all? The first step in helping answer these important questions is to get organized. Whether you use simple, tried and true Excel spreadsheet or one of the many available smartphone or tablet apps, you first have to get an idea of what money is coming in and going out and when it's happening. Ready to get started? Before you do, let's go over the second behavior that can impact your overall financial health. While you begin to organize your income and expense picture, it is essential to make sure you keep the big picture or a comprehensive financial plan in mind. Why? Because trying to get organized without a comprehensive financial plan is like trying to drive to a new destination without a map. We have observed many families that may have the tools and discipline for savings, but still fail to keep the big picture in mind. As a result, we find saving in the wrong places, in the wrong types of accounts, and investments that do not meet objectives or fall below expectations for performance. A comprehensive financial plan provides both a snapshot of current family information, such as employment, income, expenses, and investments, and a future perspective of how various changes might impact your financial health. It shows where you are and where you want to go, and providing the map of how to get there. Let's briefly go over some scenarios you may face by not starting with this financial map in place. Don't get me wrong, if you're either saving into an IRA or employer-sponsored plan, I want to congratulate you. You've already achieved behavior number 1. However, merely saving into one of these accounts may not be enough. In an area when traditional pension plans are being replaced and we're seeing an ever-changing Social Security landscape, allocating every dollar to the right savings account properly aligned with an end goal in mind is crucial to your retirement and financial health. For example, a traditional IRA is great, but you can only contribute $6,000 to this account annually. Will this $6,000 a year get you where you need to be when it's time to retire? When you can contribute as much as $19,000 annually to an employer-sponsored plan such as a 401k? Most employer-sponsored plans offer matching options. Choosing not to participate in these is like walking away from free money that could dramatically impact how quickly you achieve your retirement financial goals. But what if your employer does not offer such a plan? What if you own a business? Should you consider a SEP IRA or a KEO plan? What about your spouse? Can he or she participate in an employer-sponsored plan? What if they don't work? These appropriate, customized questions can't be answered using a simple savings strategy, which is why a comprehensive financial plan is crucial. I've observed over the years individuals saving toward a traditional IRA or a traditional 401k when they should be saving towards a Roth IRA or a Roth 401k. What's the big deal? What are the implications? Well, the difference can impact your tax situations years later, when the last thing you need to be worrying about is more taxes. In case you are unaware, saving towards a traditional IRA or a traditional 401k provides tax relief now when you can deduct your contributions and lower your taxable income. However, this also means when it's time for you to use it later in your retirement years, there are tax implications involved. A Roth IRA or a Roth 401k may not provide deductibility benefits now, but since the contributions are after tax, there are more favorable tax treatments when you start using the account in your retirement years. There are also more accessible transfer options for the Roth IRA and Roth 401k to heirs and family members. So which is right for you? You have some projection of what your Social Security income, your military pension, and your VA disability income may look like in your retirement years? How will supplemental income from your traditional IRA or 401k impact your tax bracket? Although the financial plan does not provide direct tax advice, it will most likely request this for future income data, which can provide the big picture perspective that helps you strategize for the future. Once you gain a more clarified and focused future income projection from the financial plan, we highly recommend you consult your tax professional. Matching this plan with your current taxable income, average, and marginal tax rate determines which IRA or 401k is the best for you. Already feel like you are invested too much into a traditional IRA or traditional 401k? No worries. You can always consider other conversion methods to transfer to a Roth. But again, consider this all within the context of your comprehensive financial plan and tax picture. So, what are some potential consequences of not saving with a big picture in mind? I once worked with a service member who rolled over their entire thrift savings plan into a variable annuity IRA. Not only was this variable annuity IRA locked and untouchable for 7 years, but the member was also paying over 3% in fees and was limited to only a few investment options. When I asked why he rolled over this TSP account, he told me that he had a family member who was in the business and thought it would be a good strategy for him. This is an example of not starting with a big picture financial plan in mind. And it is unfortunate to see members and clients investing without a purpose or objective. I have other examples, like when service members purchased real estate properties for rental income, but were unable to get out of the investment when they were no longer able to manage the property properly. And of course, I have to mention the example of a retired colonel who came to us to review his portfolio, which he thought was balanced, mix of domestic and international stocks. Upon our review, we found they simply were not. This so-called diversification strategy simply wasn't managing volatility correctly, and it impacted his overall performance. After reviewing his portfolio, we properly realigned his investments for both protection and growth, and continue to rebalance his portfolio to this day to make sure this realignment stays within his overall investment objectives. I have observed many individuals get into certain types of investments because they were simply at the right salesperson's place at the right time. Don't get me wrong, variable annuities, real estate, Bitcoin, and other investments are all legitimate options and have their purpose. But are they right for you? Will they be available at the time you need them? And are they within your investment objectives? Again, instead of simply investing, if you start with a comprehensive financial map in mind, there is a higher probability that each investment you select within your portfolio has a purpose and an objective within your plan. And with that comes a higher probability of success and better financial health. The third common behavior that we have observed over the years is that some do not plan for the unexpected. And more importantly, they do not consider the different types of unexpected events. Don't worry, our intent is not to provide a doomsday scenario nor apply scare tactics. We simply want to help you organize and prepare for the different types of unexpected life events require different responses. An unexpected death in the family is an emotional and financial challenge that takes an immense toll on all involved. There are many unknowns and questions that the family must answer, and without proper planning, the family will have additional challenges in dealing with a loss. Yes, many consider life insurance, but what type and how much is right for you? Are you trying to protect the family and help them with immediate bills, or trying to provide for future loss of income as well? What about the loss of dependents? How will that impact your family? Thinking about the potential death of a loved one before it happens isn't pleasant, but the process allows you to feel comfort in your plan should you ever need one. Another type of unexpected event a family must prepare for is a medical emergency. In addition to making sure your medical insurance matches your needs, you must also consider short-term and long-term medical events. Whether it's from medical bills themselves or a temporary loss of occupation and income, the number one reason for bankruptcy in America today is due to an unexpected medical event. For short-term medical events like surgeries or recovery from automobile accidents, you may look at disability income insurance and ensure emergency fund is adequate. For long-term medical events or ones that involve extensive recoveries such as stroke, mental health issues, or cancer treatments, consider long-term care insurance and related options. What is the likelihood of this kind of event, especially given your type of occupation? What will the impact be if you are not able to work for 6 months? These are important questions to consider when planning for the unexpected and can help you proactively cover your financial basis. From the political landscape to local and national economic conditions, unexpected changes across the globe can also impact your retirement and overall financial health. 2020 is the perfect reminder of how world events can change our daily lives and the importance of planning for the unexpected. You can always prepare with an emergency fund, but are your investments also prepared for these risks? A correction in the stock market, the departure of a major employer in your local area. One common way to manage your investment risk is to diversify your portfolio among different types of asset classes. However, are you certain that your portfolio is diversified? A properly diversified portfolio should vary between types of assets and also within those asset classes. And what is the correlation between asset classes? Are only having domestic US stocks and international stocks enough? Again, more questions to consider when you look at managing external risks. Like the retired colonel I mentioned earlier, by properly realigning and continuing to rebalance your portfolio, you will be better positioned to weather unexpected financial storms. The final behavior I want to discuss with you, and one I find quite often, is not working with the right financial professional. Though the term financial advisors can cross over into different definitions, the standard under which they operate and how they're compensated can have a major impact on your overall financial health long term. First, let's review financial advisors who operate under the fiduciary standard versus one who operate under the suitability standard. So what exactly is a fiduciary? A fiduciary is a person or organization legally and ethically bound to act in the other's best interest. Fiduciaries manage assets for the benefit of the other person rather than for their own profit and can't benefit personally from their management of assets. How does that apply here? Under fiduciary standard, the financial advisor must justify that the products meet the best interest of the client, consider all other options, ensure that the investment objectives meet the other needs of the client before they start the account. You definitely want to work with a financial advisor that is either a certified financial planner, CFP, which is a fiduciary, or a financial advisor that works for a fiduciary organization like AAFMAA Wealth Management Trust. In direct contrast, a financial advisor who works under a suitability standard is more of a sales process and only needs to make sure that you are able to purchase the product or service, not whether that particular service or product benefits your overall financial health. This often results in clients and customers who purchase products and services that do not meet investment objectives, time horizon, and liquidity needs. It's also important to fully understand how your advisor is compensated and paid. The simplest, most transparent method of compensation for a financial advisor is a fee-based financial advisor. This structure is where the client pays a straightforward fee, usually a percentage of an account value, for the products and services provided. It is simple in that when the accounts are managed and handled well, the clients do well, the financial advisor does well, and the organization does well too. It is in the best interest of all parties for the proper due diligence and consistent communication. There are also financial advisors compensated by commission only, meaning that the advisor is compensated only upon the sale or distribution of a product or service. We most often find a suitability standard in this structure, one must exercise caution and ensure that the products and services recommended are truly in their best interest before making a decision. Some advisors combine both fee-based and commission-based compensation. They may offer products where they assess a fee to an account value, but also recommend products and services for a commission payment for their revenue. Personally, as a senior relationship manager here at AAFMAA Wealth Management and Trust, I enjoy our fiduciary standard because it keeps my relationships with my clients simple and straightforward. I don't have to worry about which products yield the highest commission. My sole focus is my client's long-term financial health. Every family's needs are different based on their goals and objectives. We ask that you keep these common behaviors in mind and find progress accordingly. Not sure which behaviors are impacting your financial health or how to develop a strategy to change them? AAFMAA Wealth Management and Trust relationship managers are standing by and here to help.
Thank you so much, Young. That was an incredibly thorough and helpful presentation. So just as a reminder to everyone, if you submitted any questions during this presentation, or if you have any more questions later, we'll be reviewing all of those and getting back to you within a few business days. Again, if you think of a question later, you can see Young's contact information here on the slide, and you can feel free to reach out to him or to Wealth Management and Trust directly. This weekend, you'll be receiving an email to show you how to access a recording of this presentation, as well as the slides of this presentation. And you can always register for future webinars and review past webinars on afma.com/webinars. So that's all for today. Thank you so much for joining us, and we look forward to our next opportunity to assist you.